Hello and welcome to my channel. This video is part of NISM Mutual Fund tutorial. I've already uploaded chapter 1 to 11 of this particular playlist. So I request you to watch those videos as well. You can get the link to the playlist in the description box, at the I button, as well as at the end of this video. And finally, we are at the last chapter, which is chapter number 12, which we would be covering today. It is mutual fund scheme selection. And for each of the video uploaded till now, and even for this one, I have included MCQs at the end of the chapter. So do not forget to do not miss that. Do not forget to watch that because it would be really helpful for your NISM exam. And I hope by going through all the videos, by going through the full module, you would be able to clear your exam with very good scores. And if you like the video, do hit the like button and do not forget to subscribe to the channel. Now let's start with this one. So as I mentioned that this chapter is all about scheme selection. Now you can think of this in two ways. Like as an investor, if you're going to invest, you know that there are varieties of mutual fund schemes available in the market. So how do you opt for the best possible scheme according to you? Because we know that investor needs are different. So first point is investor need. The selection of a mutual fund scheme for an investor will depend upon the need that the investor has from the investment. So as I said that as an investor, you can have different need from other investors. Some investors, they look for long-term capital appreciation. So they generally choose funds like equity funds, where it is recommended that at least for 3 years it should be holded because the equity funds are prone to a lot of fluctuations. And if we want to get good returns, it would provide that only in longer period of time and long run period. So long-term capital appreciation is need of some of the investors. Some investors look for periodic income, so they generally want to invest in those assets which are not so risky and they can get a source of income from there. So they generally choose for this fixed maturity plan, or there are other plans like in mutual fund schemes also the plans like SWP, which is systematic withdrawal plan, which provides a source of income at regular intervals. Then there are investors looking for tax saving funds. So for example, ELSS, which is equity linked savings scheme, which provides you tax saving when it comes to income tax under section 80C. So tax saving is again one of the need of the investor. Liquidity, some investors, they want that if they have parked their money in any particular mutual fund scheme, it should be liquid enough. Like they should have free entry and exit. Whenever they want to redeem their money, they can redeem. They don't have to hold it for a certain period of time. So these are generally looking for open-ended funds so that they can redeem their money as and when they wish, and they don't have to hold it for a certain period of time as happens in the close-ended schemes like fixed maturity plan and all. Then some investors are looking for short-term gain, and then they want to rely on short-term profit as possible, as early as possible. So investors' need can be different, and here we just saw that even when it's about scheme selection, what particular scheme am I going to choose, that depends on what need exactly I'm having. Am I looking for a long-term capital appreciation? Do I need a fund where I want even to save on my taxes? Do I want a periodic income? Am I looking for short-term profits and all? So investor need can be different. If you as an investor, you have to choose a particular mutual fund scheme, you need to analyze what exactly you want from your investment. Now, second is risk profile. You have a particular need, but are you ready to take the risk according to that need? Because most of the investors, they are looking for high returns. They want that if they are making investment in mutual funds, they expect that they would be getting higher returns as compared to if they would be parking their money in fixed deposit or something which is totally risk free. Here in the mutual funds, there are risk related. They know that, and thus they want and they expect that they should get higher returns. So Okay, if you are looking for higher return, what is your risk appetite? Because we know that mutual funds, there are different funds. There are equity funds, there are debt funds, there are hybrid funds. And in this video only, we would try to categorize that which funds are more riskier, which funds are less riskier. So how you can recommend as a distributor also, if you are recommending to an investor, how you should recommend depending on the investor risk profile. Risk profile exactly is combination of three things. That is, what is the need to take risk? Why is the investor willing to take risk? And the ability to take risk. So if there is an investor, what is its need to take risk? How much risk is he capable of taking? And the willingness. Willingness is totally a choice whether an investor want to invest his money in a riskier asset or not. Ability is his financial situations, or we can say the dependence on him. So more the financial situation would be good, there would be lesser dependent on the investor. He would be having more the ability to take risk. The ability to take risk would be on a higher side. So this is what we call as ability to take risk. The need to take risk, of course, if you want something like you want to fund where you can generate a return percentage between 15 to 20% is what you expect down the time period of 3 to 5 years. So no one would recommend you a debt fund, because we know that debt schemes provide you lower return because the risk associated is also low. So the fund recommended to you would be an equity fund, exposure to equity related instruments. So because there is a need to take risk, if you want to achieve your goal after 3 years of time, say you want to buy a car and you have planned that after 3 to 5 years you have to buy that, you need to buy that car. So you have to take a particular risk, and this equity fund would be suggested to you. So the risk profile of the investor is very important, that whether investor is ready to take the risk or not, because investor is having certain expectation of the return percentage, and if he is not ready to take the risk and wait for a certain time period of his investment, then how would that be possible? So it becomes important, even for the mutual fund distributor, it becomes important to make the investor aware about these pros and cons if he is looking to invest in a mutual fund scheme. And even as an investor, you should be fully aware about this, that what are your requirements and how you are going to achieve that. Then comes the asset allocation. The investor's need from investment, time horizon, risk appetite, and return expectation together constitutes the base for asset allocation. So asset allocation again is what is based on all these things, like what investor wants from his investment, what is the time horizon, will he be holding his investment for a longer period of time, for example 5 to between after more than 5 years we can say, or more than 3 years, or will it be for a shorter period of time like less than 3 years? What would be the risk appetite, whether he is ready to take higher risk, whether he is looking for lower risk instruments, and what is the return expectations from that. So keeping all this in mind, asset allocation is decided. Asset allocation, we know that for example in equity fund, more than 65% of the allocation of money goes into equity related instruments. Same goes with debt funds. More than 65% goes in debt instruments. And when we talk about hybrid fund, we know that there is the three different approaches: aggressive, balanced, and conservative, where it is invested in proportion. Like in equity, there would be going certain amount of money, then certain left out money would be going into debt schemes. So there is a kind of balance between equity as well as debt fund. So asset allocation is that we are deciding that in which particular financial asset class how much money should go. Now how do we decide that? So these all factors provides a base for that decision, that what should be the asset allocation. Then comes the age of the investor. Now, it is popularly believed that younger the investor, more the potential to take the risk. So it is also, you would see in many of the books, it is mentioned that when people are at young stage, they should take higher risk when they are making investment. And the reason is that if you are young, you are not married, so you are not having any dependent on you, believing that the wife, your spouse, maybe your husband, maybe your wife is not working. So if he or she is not working, he would be dependent on you. So believing that at the younger age you are not married means no dependent, you are not having any kids. It means your whatever money you are earning from your job is totally for you. You are not even giving that to your parents because your parents are fully self-sufficient for them. So believing all that in your young age you are you are having all your money that you are earning from job, and you are not having so much of responsibilities that you need to adhere to. So in that case, you are having this higher potential to take risk, and you should be recommended to take higher risk because maybe at this point of time you are spending your money in luxurious things, in lavish lifestyles and all. So if you are taking higher risk and investing some amount in equity funds and riskier assets, so maybe there would be a probability that you would earn quite a good amount out of your money. Rather than spending, you would be investing and you would be earning money out of your investment. So this is generally believed. However, this may not be correct in everyone's case, in every investor's case, because they have different financial goal at different age levels. So maybe at somewhere in the elder age also you are ready to take risk. You are having what do we say, that you are financially too stable, and you know that this much proportion of money you can take risk on it. It won't make your financial condition unstable as such. So it depends that what is your financial position at a certain age level, what is your financial goal, and then it could be like your investor. As an investor you can be totally good with it going. But popularly what was believed was that younger the people, more the risk, elder the people, lesser the risk they would be ready to take. Then comes investment time horizon. Longer the horizon to the goal, the ability to take risk is higher, whereas one may avoid risk when the goal is in the near future. Okay, so that's why when we say like equity funds are recommended for a longer period of time, more than 3 years, generally all the distributors, you would be, when you go through distributor and when you make an investment, they would say that sir, ma'am, please hold it for at least 3 years. After that only you would be able to see a good return percentage, and don't get panicked with the fluctuations even if it goes down, or don't get panicked with such situations. So this is just to make you assured that equity funds or riskier funds, they are more prone to the market fluctuations, and it may happen that they provide you negative, your money invested amount goes into negative terms and then it comes back, maintains pace. So for a longer time horizon means you had been going through certain period after which you would be getting that particular return percentage. So longer the horizon to the goal, the ability to take risk is higher. Here it is trying to say that if you as an investor, you want to invest for certain particular goal you want to achieve. So many times what happens that investors are having certain financial goals in mind, and that's why they start their investment. So these financial goals could be your children's education, your children's marriage, buying a house, buying a car, anything. And we know that these are such financial goals in which there is longer time period you want to wait for, you want to invest for, because this would require a huge amount of money. So as an investor, if you are having this longer horizon, longer time period of investment, you would be, the ability to take risk would be higher, because you know that with the time managing the fluctuations, you would be getting a certain good return percentage. So you can take higher risk, you can invest in equity funds. Whereas if you are investing for a shorter period of time, you should avoid risk. You should not, you won't be taking higher risk in that case. You can go for balanced fund as such, where you would where you would get equal exposure to debt and equity. Because if you are investing for shorter period of time, one cannot promise you that the market would bring you drastic return percentage, because we know that it's not so certain, and it cannot be recommended. So investment time horizon, thus it matters a lot when you are going for scheme selection. Then comes core and satellite portfolio. So ideally the portfolio should be divided into two forms, that is core and satellite portfolio. Portfolio means all those where the investment is going to be made. We know that one particular mutual fund scheme, it is having its own portfolio where the investment is made into different companies, into different sectors, the stocks of different companies and sectors that are being traded, different financial asset classes. So that's called portfolio. and it should be divided in two parts, core and satellite portfolio. Now the core portfolio will be invested according to the long-term needs and goals of the investor. The satellite one will be invested to take advantage of expected short-term market movements. So this is what is recommended ideally, that if you are making a portfolio, try to make it in a way that there should be a core portfolio which would focus on long-term need and goal of the investor. So it would be making investment in such stocks or such shares which would be providing long-term capital appreciation. However, certain amount of money should be there, as they are called as satellite portfolio, should be invested in this, which would be taking advantage of short-term market movements. So many a time it happens that in short term only the market is going high, it is going through bull run, and then the advantage must be taken. We just can't hold, we just can't keep on holding for longer time gain. So in that case, short-term market movement should be taken as advantage. So it would be better that if the portfolio is divided as such, where it is focusing on both the long-term investor need and the short-term market movements. So this is all about scheme selection. Now let's come to risk hierarchy or levels in the scheme. So as I mentioned, that what is the risk associated with certain mutual fund? We know there are different numbers of mutual fund present in the market. So how do we come to know that whether one is high risk, whether one is low risk? So getting an idea about it, you must be aware about this. If you are going to be a mutual fund distributor, you must be aware, it's very important that you should know that which mutual fund is more riskier, which is less riskier, what you should recommend to the investor. And also from your exam point of view, for this particular chapter, chapter number 12, this is very compulsory. Just note it, you would be getting 1 or 2 questions out of it definitely. So you need to keep in mind which stock would be riskier, which would be less riskier. So just have a look over here. I've tried presenting it in a simpler manner so that you can understand. So just keep in mind that when we are going from left to right, it means from left to right. When we would be moving like this, the risk and return will be going low to high. Okay. So it's like when we are at liquid fund, we know that it is having lowest risk and thus we can expect lowest return as well. As we move to debt fund, it would be having more risk than liquid fund and more return than as compared to liquid funds. When we move to hybrid fund, it would be having more risk as compared to debt and liquid fund, and thus return would also be more as compared to debt and liquid funds. When we move to equity funds, we know that it is having highest risk over here and highest return can be expected. Okay, so this is how you have to move in this chart. From left to right, risk and return would be low to high. So the one that are in the left are one that are having lowest risk and would be providing lowest return. The one that are in the right side of this chart are the one that is having highest risk and you can expect highest return percentage from that. Okay, so this was a simple rule that you need to follow. So let's start with risk return hierarchy of mutual funds. So in general, how we categorize mutual fund is liquid fund, debt fund, hybrid fund, equity fund. So you can see the hierarchy of risk and return. As I already mentioned, while you go from left to right, you are going from lower risk to higher risk. You are going from lower return to higher return. Now, as we move to risk return hierarchy of equity funds, you can see that at the left point is large cap funds, because we know that large cap fund invest in companies which are having highest market capitalization, and these are the most stable and the profitable companies in the market which are growing for quite a few years. So large cap companies are not so riskier as considered to small cap companies or mid cap companies, and thus large cap funds are at the left side. It is at the lowest risk and lowest return possibility in shorter period of time. Then as we move forward, we can see multi-cap fund. Multi-cap fund invest in all these 3 capitalization: large cap, mid cap and small cap. So it is a kind of diversified among companies with various market capitalization. And then we can come to mid cap and small cap. So small cap is the one having highest risk and highest return can be expected if these companies perform according to expectations. So it can be provide highest return percentage in favorable possibilities. So moving from large cap to multi cap to mid cap and small cap, this is how the hierarchy is going, from lower risk to higher risk, from lower return to higher return. Now let's see risk return hierarchy of diversified to concentrated funds. If you're not sure about what all these type of funds are, if you are just watching this video, you haven't watched the previous videos, I would recommend you that do watch those videos where I've also covered about type of mutual funds. You would get a better idea that what exactly these funds are. I'm not repeating it because I've already covered it. So now coming to diversified to concentrated fund, we know that more would be the fund diversified. It would be having an exposure to different companies, to different sectors, to different financial asset classes, and hence the risk would be on lesser side. And diversification is done with the motive to reduce the risk associated. So diversified fund means having lower risk. But as we move forward to focused fund means it would be focusing on about certain number of companies and only those companies would be there in the portfolio. So that's what called focused fund. Then moving to thematic fund, which follows a particular theme. Then moving to sector fund, which invest in only one particular sector. For example, banking fund investing in banking sector. Then there is technology fund investing in technology sector, healthcare fund investing in healthcare sector. So we know that sector fund is highest riskier fund. Even in terms of all equity funds, sector fund is having highest risk because it is concentrated towards only one sector. So if that sector won't be performing well, your totally invested money would go through a lot of loss. So sector fund is having high risk, but again it is having possibility of high return. Suppose that sector is performing very well, you would be getting highest possible return out of it. So sector fund again comes with higher risk, higher return, diversifying fund, lower risk, lower return. Okay, now let's come to risk return hierarchy of hybrid funds. It moves from arbitrage fund to equity saving to conservative to dynamic asset allocation, multi-asset allocation, balanced and aggressive. Aggressive is at the last point, at the most right side. It means it is having highest risk associated and highest return possibility. We know that when we talk about aggressive hybrid fund, we know about hybrid fund that investment is made in both equity as well as debt. So when we talk about aggressive hybrid fund, they allocate most of the money, like more than 65% of the money in the equity class, and then whatever left is that would be invested in debt. So major proportion of money goes in equity instruments and lesser proportion of money comes to the debt instrument. That is what is called aggressive hybrid fund. So here the more exposure is towards the riskier instruments. When we talk about conservative, we know that major proportion of money, like more than 65%, goes into debt fund and lesser would goes in equity fund. Same when it comes to balance fund, 50-50 proportion investment amount is made in both equity and debt schemes. So this is how it works, and this is how we can get an idea that where the risk is low, where the risk is high, where we can expect low return, where we can expect high return. Risk return hierarchy of debt funds. So just go through it. Overnight fund, liquid fund, ultra short duration. We can see that shorter the duration of the fund, lower would be the risk. Higher the duration of the fund, higher is the risk. So from overnight fund to liquid fund to ultra short duration, low duration, short duration, medium to long, and then long duration fund. So longer would be the duration of the fund, lower it is having, higher it is having the risk, and lower would be the duration of fund, lesser is the risk associated. So overnight fund is having the is at the left side, so it is having the lowest possible risk, and the long duration fund, it is on the right side, it is having the highest possible risk, highest possible return can be get as well. So I've already mentioned about this when we are studying about debt funds. We know that longer would be the duration of the fund, higher would be the risk associated, because the prices of the bonds and the debt instruments that are they are quite influenced by the changes in interest rate. I already covered in one of the previously uploaded videos. So I mentioned that whenever the interest rate changes, the prices of the debt instruments like bond prices, they are fluctuating. So longer would be the duration of the particular debt instrument, longer would be the duration of particular bond or debt fund. We know that higher would be the risk, because longer the time, there is more chances of interest rate fluctuation, which would be affecting the prices of these instruments. Now coming to hierarchy of credit risk and debt funds. So credit risk, we know that credit risk is the possibility that the another party where you have invested, who promises you to pay a certain return percentage, or you expect to get certain return percentage, if that party defaults, that is referred as credit risk. He is not in that financial position to pay you the money back. So gilt fund is having the lowest risk, and as we move from left to right, we can see the highest risk is at the credit risk fund, and thus highest return can be expected from here, and the lowest return is at the gilt fund, that is government investing majorly in government securities, and that's why it is the most safer instrument. Even if we compare to all those asset classes, gilt fund is one which is at the most left side. It is having lowest risk associated, because these are investing in government securities, so government pays back the money. Then it comes to banking and PSU fund, corporate bond fund, and credit risk fund. So this is, you need to keep in mind the hierarchy of risk and return, low to high from left to right. Now let's come to representation of risk, how it is represented when we go through the mutual fund company's website as an investor, when we are looking to it, or when we go through the scheme information document, how is the risk level represented. So blue represents the principal money at low risk. So all the mutual fund schemes that are having low risk, it would be represented by blue color, with this square box which is color coded in blue. Then there is yellow color representing your principal invested money at medium risk. And then there is brown color representing that your invested money is at high risk. So just keep these color code in mind, and this is how the depiction is made for the investors. Also, you must have seen this this depiction in the on the website of the mutual fund companies, or even in the scheme information documents. You must have seen this. I think it is mandatory by SEBI to represent the risk levels in such a way so that it becomes easy for the investors to understand. So just see that wherever this it is represented as from moving from low to moderately low to moderately high and to high. So wherever would be a particular mutual fund scheme, how whatever risk parameter it would be having, that would be represented by this one. So here principal is at moderate risk, and as you can see, it is clearly mentioning that your invested amount is here at the moderate risk. If it would be moderately high, it would be over here. If it would be high, it would be over here. So you can just have a glimpse, and you can instantly get an idea that this particular mutual fund scheme, whether it is at low risk or whether it is at high risk. You can just have idea about here. Just go through it. Level of risk, it is low. It means your invested amount, your invested principal amount, it is at low risk. And some of the examples of mutual funds having lower risk is overnight fund or liquid fund. Then moderately low, some examples are fixed maturity plans, capital protection plans. Moderate risk, example conservative hybrid fund. Moderately high, example index fund, exchange traded fund, equity fund, solution oriented schemes. And high risk, example sector fund, thematic fund. Now let's move to scheme selection based on investment strategy. Okay, so I've already talked a lot about these all things in the previous videos, but again to recap and make it clear to you, because it is mentioned in your chapter number 12, it should be you should understand this. So let me just go through it. Active fund versus passive fund. So as an investor also, when you are going to choose a scheme, you must look after that whether that fund is active or passive. What does it necessarily mean? That active funds are actively managed by the fund managers in terms of portfolio selection, asset allocation, weightage, market strategy, etc. So if there is a particular mutual fund scheme which is an active fund, it means that the fund manager who is managing that particular fund, he would be actively looking into the portfolio of that particular scheme. So the fund manager would decide what all companies should be there in the portfolio, how the asset allocation should be made, how much money should go in which asset class or which particular company. So the weightage is decided by the fund manager. The market strategy is looked after by the fund manager so that right decision can be made at right time. So here the fund manager who is professional in managing these mutual fund schemes, he is totally involved in managing your particular fund and managing your invested amount. And thus you also must notice that higher fees would be charged as compared to the passive fund. So when you are investing in active fund, it would be involving higher fees because fund manager is actively involved in managing your fund and providing you the expected return percentage or meeting your investment objective of the particular scheme. So higher fees would be charged as compared to passive fund, whereas when we talk about passive fund, it involves generally tracking a market index as it is. So for example, there is this fund called Sensex fund. So it would be just tracking the index BSE Sensex and what all companies are there in the Sensex, listed in the Sensex, the 30 companies, the same companies would be there in this Sensex fund. And the same asset allocation, the same weightage of the money would be replicated here as well. So passive fund is not much to do by the side of fund manager. Fund manager is not actively participating. He is not making decision on what all stock should be chosen, what all companies should be there, how the weightage should be provided. It is just tracking the market index. And thus you can see that the lower fees charged is here as compared to the active funds. So we mentioned that active funds, there would be higher fees charged, whereas passive fund, because fund managers are not much involved, it is just tracking a market index and putting the same assets, same companies in the portfolio. So there would be lower fees involved. Now you can also make a choice between open-ended fund and closed-ended fund. Till now we are clear about this, that the open-ended schemes are those schemes where an investor could enter and make an exit at any time, even after NFO. NFO, we know that when first time the mutual fund scheme is launched in the market, it is called new fund offer, which is for a certain time period. And once the NFO is closed, the open-ended schemes are still there in the market. So any investor can make investment, can buy the units of the scheme, can sell the units of the scheme, can redeem its money. So the entry and the exit from a particular scheme is totally free for the investors, and those schemes are referred as open-ended schemes or open-ended fund. However, when we talk about close-ended funds, these are those mutual funds that comes with a fixed maturity. So once the NFO is closed, investors can buy units of close-ended scheme from the fund only during its NFO. So only when new fund offer is going on for a certain period of time, then only you can buy units. And once it is closed, you won't be able to sell it. So only when it would be listed on stock exchange, you would get that choice to sell your invested units or the units that you are having from a particular scheme. So only when it is listed on the stock exchange. Otherwise, you have to hold it for a certain time period, and once the fund would be mature, once the time period would be completed, then you would be able to redeem your money back. So those are called as close-ended fund, which comes with a fixed maturity date, which you need to be holding your investment amount to. Now let's see diversified versus sector fund. We have already talked a lot about it. Just go through it. Diversified fund invest across various sectors, various asset classes and companies to provide a wide exposure to the portfolio so that diversification is maintained and risk is reduced to a certain level. Whereas sector fund, they invest in one particular sector such as bank, power, infrastructure, pharma, technology, real estate, etc. So we know that sector funds are more riskier as compared to diversified fund, because diversified fund are investing across various asset classes and companies and stocks. So even if some of the companies are not performing well, we know that other can be performing well at the same time. If one asset class is not doing good, other asset classes will be performing well. Whereas sector fund, it is only on one sector. So if that sector is not performing well, it means you are losing your money. There is no scope left. So sector fund are riskier than the diversified fund. Now let's come to large cap versus mid cap versus small cap fund. So large cap stocks are of established companies that have stable revenues and profitability and the financial strength to withstand the competition. And these are the companies which are having good reputation in the market. They have made their reputation. They have earned they have increased their branches and created a presence in the market. So these are large cap companies which are having the largest market capitalization. Then comes the mid cap and small cap companies. So those are still in the initial stages of growth. These are the companies which are having a lot of scope to grow in the future, but still they are not at that point. So they are at the initial phase of their business. Okay, so investors should also decide that whether they should want to go for stable companies, less riskier companies like large cap, or whether they would like to take a risk and go for companies that are at an initial stage and may grow in future a lot. So like mid cap and small cap. So investors have to make a choice between that as well. Growth versus value fund. Funds that follow the growth strategy seeks to identify companies that are expected to grow at rates higher than the average economic growth rate, whereas value strategy seeks to identify stocks that are available at a price that is seen as cheap relative to the value that could be unlocked in the future. Okay, so let me tell you, growth fund would be investing in those companies which are already growing. Okay, so these companies have already maintained an average economic, have already maintained a higher growth rate as compared to the average economic growth rate. So those companies are highly valued, or what we can say that the share prices are highly valued in the market by the investors, though as compared to earnings. So maybe the earning is not so much going on, but since the company has made such a reputation and it has performed well for past few years, it is now priced, it is now overvalued, or it is now priced more than its intrinsic value in the market. So those are referred as growth companies, and the funds that are investing in growth companies are referred as growth fund, whereas value funds would be investing in the value companies, which means the stocks of those companies that are available at a lower price. So the company is quite performing well, its earning is good, but still the market has not identified its true potential. So maybe right now its prices are available for cheap, but in future when the market would identify the true potential of these companies, it would be highly valued. So value companies are available at cheap prices, at low prices. However, they are financially strong and good companies. However, the growth companies, they are financially strong, they are good companies, and are also highly valued in the market. So the only difference is in the prices of the shares of these companies. So growth companies, growth companies are highly priced, value companies are having cheaper prices in the market. So there is more scope for growth in the future in the value companies. So when we talk about value funds, it means investing in those kind of shares of the value companies. Growth fund, investing in shares of the growth companies. Okay, so as I mentioned that as an investor, you can go through all these criterias, you can decide which scheme is suitable for you, but as a mutual fund distributor, it becomes very important for you to be well aware about all those things, so that when an investor comes to you, you can make the right, you can suggest the right particular mutual fund scheme for that investor. Selection of mutual fund scheme offered by different AMCs. Matching funds portfolio with its investment objective. Most AMCs share the portfolio of all their schemes on their website. Investors should evaluate whether the fund's portfolio reflects its investment objective. So we have already learned about this a lot of time, that one mutual fund scheme, they have a whole lot of portfolio consisting of different stocks of consisting of stocks of different companies, different companies of different sectors, and then different asset classes. So there is a whole portfolio. However, the top 10 holdings of that portfolio is represented for the investors on the website. So when you go to the AMC's website or mutual fund company's website, you can get an idea that what all companies they have invested your money in. So top 10 holdings where your money is invested, you can get an idea where exactly is your money going. Then fund manager. Also some people they look for fund manager when they are going to select a particular scheme. They believe that the fund managers that has been more experienced in this particular field, they are more knowledgeable of identifying the changes in the market trends. They can be making right decisions. So they try to analyze the fund manager's performance as well. So if one particular manager is controlling your particular mutual fund scheme, how he has been performing, what has been his experience of years, and what exactly has been the performance of a particular mutual fund which he was managing in the previous time or in the past time. So they also rely on fund managers. Better the fund manager, more skilled, more knowledgeable the fund manager, better would be your investment choice. Fund performance. The return that the fund has generated relative to its benchmark are evaluated over a period of time. So we learned about this in the chapter where we were going through the benchmark. We know that for every mutual fund scheme, there is a benchmark set, and the mutual fund scheme tries to outperform the set benchmark or the set target, because there should always be a target set if you want to achieve a particular goal. So they try to outperform the benchmark that they have chosen. So this is how the fund performance is measured. It is measured that whether it has been how it has been performing as compared to its benchmark. Fund portfolio. The fund portfolio has to be evaluated to determine the risk and return in the scheme. Obviously, if you are going through the portfolio, if you are going through the companies involved in that portfolio, you are getting an idea that what all companies are, whether they are large cap, mid cap, small cap, what would be the risk associated, and what return percentage can you expect out of it. Fund age. A fund with a long history has a track record that can be studied. A new fund managed by a portfolio manager with a lackluster track record is definitely avoidable. Okay, so fund age, it means that one mutual fund that is there in the market for a longer period of time, it means it is having a whole set of history of track records, its past performance, the fund managers involved, how it has been evolving over the years. So better, more would be the fund age, more you would get an idea about a particular fund related to its past performance, its track record, what we say, how the market has positioned that particular mutual fund. Okay, so if there is a new fund which is not having a good fund age, which is managed by a portfolio manager, it means you are not having so much of track record which you can rely upon, and thus it is avoidable. Fund size. A large fund size will allow better diversification and economies of scale. A small sized fund, on the other hand, is more flexible and better able to take advantage of market opportunities. So both of these have its own pros and cons. You can see if it is a large fund size, it means more money has been investment. There is a whole lot of money over there, which allows to do better diversification, better investment, and provides an economies of scale and savings. However, if it is a small sized fund, there is more flexibility to take advantage of market opportunities to handle the invested amount in a good way. Portfolio turnover. Purchase and sale of securities entails broking cost for scheme. Frequent churning of the portfolio would not only add to the broking cost but also be indicative of unsteady investment management. So portfolio turnover means every time the stocks that has been included in a certain portfolio of a certain mutual fund scheme, every time that portfolio is changed, every time certain stocks are replaced by another stocks, it means that there is being changes in the portfolio. and which is referred as portfolio turnover, not just changes in the stocks but also in the weightage. So if 10% of amount was invested in one particular stock, and now it has been reduced to 5%. Another stock where the invested amount was 30%, now it has been increased to 40%. So portfolio turnover means changes being made to the portfolio. Now, this involves additional cost, which is referred as broking cost, and it also indicates that the fund manager, maybe he's not very sure about his investment management, his investment style, and that's why every time he's so confused about making a decision about particular portfolio, which all stocks should be there. It is good. Portfolio turnover is really good because when we want to take the advantage of the market, but for a certain period of time, like once in a 6 month, we are trying to change the portfolio according to the market situation. But if it is done too rapidly, it means that it is adding to the cost, and it is also showing that the management is not good in in reducing the cost of the particular portfolio. Okay. So this should be kept in mind. Then scheme running expenses, any cost is a drag on investors' return. We know that more the cost involved, more would be the expenses, and thus the return that we expect from a particular portfolio would not fetch the same. Investor need to be particularly careful about the cost structure of debt schemes, because in normal course debt returns can be much lower than equity schemes. So it is trying to say over here that even for equity schemes you can expect a higher return percentage, but when it comes to debt scheme, it already provides you low return percentage. And that also, if there is lot of cost added, if you are paying a lot of expenses, if it is cutting your amount in lot of expenses, which is represented as total expense ratio, you should not go for it, because more the cost, lesser would be the return, and in any case in debt funds you are getting lesser return. So you need to look out for the profit, whether you are actually making profit or not. Selecting options in mutual fund schemes, this also we have already covered that any mutual fund scheme, it comes with different options, two major options, that is dividend option and growth option. Dividend option could be divided in two parts, dividend payout option and dividend reinvestment option. And the second one, as I mentioned, is growth option. So you need to choose for any mutual fund scheme, it is available whether you want to go for dividend option or whether you want to choose the growth option. So in a dividend payout option, what would happen that whenever the company declares the dividend, whenever the fund declares the dividend, it would be credited in your bank account. The NAV goes down to reflect the impact of dividend paid. So obviously the NAV would be affected, the net asset value, the price of your scheme, and thus it would come down. However, the dividend that has been paid would be credited in your bank account. Then there is option of dividend reinvestment. So whenever the dividend is declared, that would be reinvested in the scheme, and additional units will be allotted to you as an investor. So it won't be credited to your bank account. It is just that reinvestment of that dividend amount is made, and you are getting additional units for your mutual fund scheme. Then there is growth option. So in growth option, no dividend is declared, and thus whatever is the NAV, whatever is the price of the mutual fund scheme, that would capture the full value of the portfolio gains. So here you are getting the what we call the actual gain percentage. Nothing is impacted. NAV is not getting impacted over here. Do's and don'ts while selecting mutual fund scheme. So first is ensuring suitability. In order to comply with SEBI regulation, the distributor is required to ensure the scheme suitability to the investor need and situation. So we already learned about this, that the distributor also, they need to present those schemes, whatever we studied till now, that what all schemes can be presented to a particular investor would depend on the investor need, would depend on the risk appetite of the investor, the time horizon of the investment. It's just to give you an idea that as a mutual fund distributor, you are responsible if you are suggesting a particular mutual fund scheme. And when you are suggesting a particular scheme, you should be very well aware that the suggestion should be suiting to the investor need and situation. This is what SEBI says. This is what SEBI expects from his mutual fund distributors. that you are going through all these knowledge, because you can recommend you can recommend that scheme which suits the investor's need and requirement and helps him fulfill his financial objective. Sticking to investors' asset allocation. The asset allocation for the investor is based on investor situation and goal. Therefore, it is a prudent approach to keep the asset allocation at the core of selection of schemes sold to the investor. So we know that investors, some of them are ready to take higher risk, some want to take lower risk. Higher risk people should be there should be more asset allocation made in equity instruments. For one who want to be at safer side, more asset allocation should be made in debt instruments. Then one who want to go for gold schemes, they generally expect that the asset allocation, the major proportion goes into the gold instruments. So this is how asset allocation should be according to the investor's choice. Praising past performance. The mutual fund advertisements use the disclaimer past performance may or may not be sustained in future. So as a mutual fund distributor also, you are responsible and you are expected that you should tell this to your investors, that the past performance should not be the thing to be rely upon. Okay, so the past performance should not be just for the future performance. Maybe the past performance has been too good and there has been a certain return percentage, but that cannot be kept as a criteria or a definite criteria of giving you a certain return percentage. And this is why you must mention this, that past performance is just to get an idea how this fund has been performing in the past, but that is not an indicator of the future performance. Keeping an eye on the taxes and loads. Both taxes and loads reduce investment returns. Therefore, it is important for the distributor to consider these two aspects during transactions. Okay, we learnt this in taxation chapter, that what all taxes and loads are involved in different kind of investment schemes, and that should be considered by the distributor when they are making any particular transaction on behalf of the investor. Consistent methodology. Developing a consistent method for scheme selection should be there, so that you don't get confused every time you are making a scheme suggestion or making a scheme selection for your investor. You need to have a consistent method, what all things you need to follow, what all checkpoints, what all do's and don'ts should be there, and thus you can recommend a suitable scheme according to investors' need and objective. Understanding the investment objective and investment strategy of this scheme, obviously. Now let's come to multiple choice questions. Till now you must have get a better idea about this chapter. So now attempt these questions. Which of the following scheme categories would be considered the least risky in terms of credit risk? First one, credit risk fund. B, corporate bond fund. C, dynamic bond. D, gilt fund. And the correct option is option D, gilt fund. For an investor to get a quick sense of the level of risk involved in a mutual fund scheme, SEBI suggested a simplified framework known as A, riskometer, B, risk factor, C, fund fact sheet, D, investor's risk profile. So the correct option is A, riskometer. Passive funds are safe as the NAV of such funds do not go down even when the respective market fall. State whether this is true or false. A, true, B, false. And the correct option is option B. Which among the following schemes would have lower risk of concentration? A, multi-cap fund, B, focused fund, C, thematic fund, D, sector fund. And the right option is option A, multi-cap fund. Dash are close-ended debt funds. A, fixed maturity plans, B, overnight funds, C, dynamic debt funds, D, arbitrage funds. And the right option is A, fixed maturity plans.